My insurance sucks. Our insurance doesn't cover anything. Either of those sound or feel familiar? It's likely the people saying such things don't actually know how insurance works, particularly health insurance. Welcome to another episode of Achieving Minerva. I'm your host, Sal. Today, we're going to try and harness the power of some basic knowledge so that we can navigate the world more efficiently. Now, to be clear, the United States healthcare system is, to be frank, a complete clusterfuck, due in large part to the privatization of health insurance. This episode does not attempt to defend the system. This is just my attempt to inform how the current system works, for better or for worse, on the user level, and not an argument of its merits. This episode is going to be almost exclusively targeted to Americans. So if you live in a different country that has some form of national health system that is public, first of all, consider me envious, but you may find this episode a little bit irrelevant. We will talk about some other insurance types as well and whether or not I think they are worth your while. First up is health insurance. We're going to cover some basic terms. Premiums, deductibles, coinsurance, copay, 80/20, 70/30, HDHP, PPO, HMO. What the heck is this alphabet soup? Well, we're going to start simple. We're going to start with premium. The premium is simply the amount you pay each month in order to have health insurance. It's either the amount that is taken out of your paycheck and is an item in your pay stub, or it is the amount you pay to the healthcare marketplace if you are on the Affordable Care Act plans, aka Obamacare. And that's it. Your deductible is the amount you have to pay before your insurance starts paying its part and starts, quote, covering anything. Usually, this number is about $1,000, but some may be upwards of $5,000, and we'll talk about that in just a minute. The premium and the deductible generally have an inverse relationship. If your deductible is low, the premium is likely a little bit higher. The reasoning being if your deductible is low, you have more frequent use of the healthcare system, so your plan starts covering you sooner, but they get your money in the monthly payments. For high deductibles, in general, those plans are best for relatively healthy people, and you get the benefit of a lower premium each month. It's kind of a risk analysis game. Am I willing to risk this high deductible on the basis that I can healthily abstain from the healthcare system for a year? If the answer is yes, then I get a lower monthly payment. Another financial point for healthy living. See the earlier episode on the basics for healthy living. Now, this is not to say that if you don't have health insurance or you do have a high deductible to not go to the doctor at all costs. You still need to go to the doctor if you need to go to the doctor. So moving on, coinsurance, copay, 70/30, and 80/20 are all very related terms. Once you hit your deductible for the year, your insurance starts to kick in, usually in the form of coinsurance. Basically, at this point, you have to pay part of your medical expenses, and insurance carries the majority of the risk. So you start out paying everything up to your deductible, then the deductible kicks in, and you start paying part of it. The term copay is basically just a fixed dollar amount tied to certain services, such as primary care physician visits, urgent care, emergency rooms, specialists, etc. So it's still copay is still a coinsurance. It's just copay is a fixed amount. 70/30 and 80/20 are merely common percentage models as a converse to the copay fixed rate model. Instead of a certain fixed dollar amount after the deductible is met, you pay 30% of all charges while the insurance pays 70%. Or you pay 20 and they pay 80. Hence 70/30 and 80/20 being the common terms there. These coinsurance models are applied up until you reach the out-of-pocket maximum, at which point you are off the hook for any covered expense. Yay! Now you get a break until the plan starts over in the next year. So HDHP, PPO, and HMO are a bit more nuanced to define because these are the names of the different flavors of plans. HDHP is fairly simple. It stands for High Deductible Health Plan. The IRS defines a high deductible as $1,500 for individuals and $3,000 for families in the year 2023. The most significant thing this does is it makes you eligible for a health savings account, which is the bomb.com for investing, because it's triple tax advantage. It's not tax going in, just like your traditional IRAs or traditional 401k contributions. It then grows completely tax-free, and then it comes out tax-free when you withdraw and you use it on medical expenses. Those are all defined by the IRS. And you can use it as a Roth IRA after the age of 65, where it is taxed coming out for non-medical expenses. And that's basically the awesome thing about HSAs. PPO and HMO are a little bit more complicated. PPO plans are generally more expensive. That means they have higher premiums per month, but you are paying for more flexibility. For example, PPO plans generally don't require referrals to see specialists, so you kind of avoid paying the primary care physician bill and the specialist bill all in one just to get one simple treatment. PPO plans are generally more common as well, and these are the ones with networks, which are a minefield of hidden fees. Services and providers in-network add up to the deductible and out-of-pocket maximum, but the out-of-network services have a much higher deductible and out-of-pocket maximum. It's also worth noting that ADHP plans sometimes also have networks to abide by with those same constraints. This is where the horror stories you read about come from, where a nurse in an OR for a procedure was out of network, unbeknownst to the patient, and then the patient gets slammed with a massive bill that they shouldn't have. So always double check about the networks with any provider or facility that's going to be involved with a service or procedure. HMOs are the opposite of a PPO in some regards. They are generally cheaper than the PPO plans, but you don't have the flexibility of using out-of-network services, which can be a hassle if you're traveling and you need to go to the emergency room that isn't in network. That's going to be a really pricey trip. So now that we have terminology covered, the sentiment that our insurance doesn't cover anything probably comes from misguided views. Because most insurance does cover most necessary services, the person saying that just thinks that the premium is supposed to cover all of the insurance. The premium is just the money that says, I would like this service. Think of it as paying for Amazon Prime. The premium just gives you access to the platform and some very basic things like free shipping. But you still have to pay for certain movies, Kindle Unlimited, and other subscriptions. With insurance, it's a lot the same thing. You have to pay the premium no matter what. And if you get sick or injured, you now have to pay to start chipping away at the deductible. For individuals who don't get sick or injured very often, they get surprised that their premium doesn't give them free trips to the doctor once in a blue moon. I pay for insurance, so why am I paying for this doctor visit is kind of the general sentiment. And some folks may not know that their deductible is pretty high. A typical primary care physician visit may only cost $100 or less. And if your deductible is $1,500, then it will feel like insurance doesn't cover anything because it takes 15 primary care physician visits in a year to meet that deductible. Then insurance starts to pay, and you still have to pay a percentage. This is one reason why high deductible health plans let you have an HSA. The HSA's primary purpose is not to be a tertiary retirement vehicle, like I noted earlier. The primary purpose is to help you save for medical expenses because most people aren't ready to drop $1,500 on medical visits. Any type of insurance is all about transferring risk. If you're able to self-insure yourself without complete financial ruin, then insurance may not be worth it in all cases. But health insurance particularly in the United States, is effectively a requirement. The Affordable Care Act made some sort of health coverage a legal requirement, but the Supreme Court removed the fee penalty for not having it. So it is a requirement, but you also don't get penalized for not having it. Makes perfect sense, right? But in the United States, it only takes one bad medical bill to ruin anyone with less than 9 figures in their net worth. We just got a bill from one single sedated MRI for our son, and without insurance, it would have cost $20,000 just for that 1 hour procedure. And we don't have $20,000. We ended up spending $2,000. So unless you have a $100 million trust fund at your back, get health insurance, even if you never have to use it. Moving on from health insurance specifically, most other insurances work the same way for the most part. You pay a premium every month to have the insurance, and if you need to use it, you pay a deductible before the insurance covers the rest. Different plans cover different things. For insurance on your house or vehicles, you'll want to double check the terms for things like hurricanes and floods. House insurance, for example, is required if you have a mortgage, because if you have a mortgage, the loaner or the bank technically owns the house, and they obviously want it insured. Depending on your area, the kinds of hazards it is prone to, you may need several types of plans. On the coast, you'll likely need a separate contract for floods, and perhaps another one for wind and hail for named storms like hurricanes and nor'easters. In the Midwest, you'll need tornado insurance. This may come as a complete shock to you, but the insurance company doesn't actually want to help you. They just want your money. And if you live in those areas, it's likely that the insurance company will have to help you due to the higher risks. So they have a base plan for things like fires, basic structural damage, but they can write out named storms and other major disasters that are common in your area. So if you own your house outright, you aren't legally required to have any insurance, but that's a lot of risk. Your house is likely the most expensive thing you own, and if it disappears one day, you'll be on the hook to build it again by yourself. So homeowners insurance, I would consider a requirement effectively, because it's a pretty dumb risk to take to not have it. For vehicle insurance, your risk is much more variable. For example, a teenager is pretty risky. Their likelihood of wrecking the vehicle is much higher than, say, a 40-year-old with a totally clean record. Teenagers are very expensive to insure, often costing families an extra $100 a month in premiums. Many companies offer discounts for safe driving, good grades, and the like because they associate those things with lower risk. Medical and liability coverage is legally required in most states in the United States. That is, if you get in a wreck and it's your fault, you have to cover the medical expenses for the person or people in the car that you hit and for the damage to that car itself. However, covering your own vehicle is generally optional. So if you have a clunker $3,000 30-year-old car, it may not be worth it to insure it because maybe you can just buy another old vehicle without reporting it to insurance that you wrecked your car. This is one where assessing your risk with a cost-benefit analysis is worth doing, given your finances, the cars you drive, and how confident you are in your ability to avoid causing the accidents. It should be noted that it's still pretty risky to not have collision insurance, but it is a little bit more variable depending on your certain situation. The other big insurance that I want to talk about is life insurance, and it works a little bit differently than the ones above. Life insurance is insuring the financial input that a given person gives to a beneficiary while they're living. If I have life insurance on myself, then when I die, the beneficiary that I named, in my case, my wife, gets the sum of the policy that I subscribe to. If we die together, our son gets the sum of money because I have him as a contingent beneficiary. There are two major types of life insurance: whole life and term. Whole life insurance is basically a hot load of garbage and almost always a scam. The company says they will insure you from now until you die, whenever that is, and the payout changes as you get older in most policies. Well, everybody dies eventually. So once you hit a certain age, the payout to your beneficiaries is basically nothing. And you've been paying a premium for decades for essentially no reason. Don't get whole life insurance. The other type is term life insurance, where you subscribe to a plan that says if I die during such and such a time period, your beneficiary will get the payout you subscribe to. Terms are usually a flat time frame, such as 5, 10, or 20 years. The company will usually ask a series of questions about your lifestyle to assess their risk. In this case, how likely it is that you will die during the term that you've signed up for. They will ask about your hobbies. For example, if you're a rock climber, you're a lot more likely to die than someone whose primary hobby is, say, board games. They ask about your body mass index, your BMI, because an obese person is more likely to have complications and die during the term than a fit person. Some companies really cross their T's and dot their I's and order blood tests to assess some levels like cholesterol and fat in the blood. Now, there is such a thing as a variable term. The most common is called a group term, and this is usually part of a compensation package at a job, where for however long you are a member of the group, or in this case, an employee at the firm, your beneficiaries will get the payout if you die while in the group. Usually these policies are free or super cheap for the employee to enroll in, but the payout that they get is not enough to cover your income that they lose when you die. So it's prudent to check into it and find a suitable outside plan to add on to that. That was a lot of words, so I'm going to use our own life insurance scenario as an example. These are real numbers to help all of this make sense. So first we assessed the risk. I am the breadwinner as far as income goes. We are in our early 30s and we are not yet financially independent. So work is, for one of us, is still a requirement. So if I die, my wife and son have no income to live on, and our insufficient portfolio would last them maybe a couple of years. So we wanted a policy to ensure against that possibility. A general rule is you want your beneficiaries that depend on your income to receive 10 times your annual income. Theory being that they invested in index funds that average 10% returns over time, and they live off that portfolio. So we have a 10-year term, $1 million policy on me. So if I die before the 10 years are up, in our case, the year 2030, then my wife gets $1 million to live off of. We chose 10 years because we expect to be financially independent enough for one of us to live on in 10 years. So after that point, we won't need life insurance. We can self-insure our lives, which is exactly what financial independence is. Work would be optional even if I was living. So if I'm not there, then work is still optional. And we chose $1 million because our overall financial independence goal is $2 million for 3 of us. So $1 million should hold the other 2 over until our financial independence portfolio matures enough to use after that million runs out, if it even comes to that. For that plan, for the 10-year, $1 million policy, we pay $15 a month. And that is fixed for the entire term. My wife is a stay-at-home parent, but don't ignore her contributions to the family. Our son is only a year old, and while her salary at her old job was around $30,000, what she does now is worth far more than that. I have fresh meals, laundry done, a happy, nurtured child, a clean house, and a lot more going on. So there's a ton that goes into keeping a house running. If she dies, I don't really lose a paycheck or income, but I lose a huge amount of help around the house. I would have to pay for childcare that I don't currently pay for, and to really replace her function with the laundry done and fresh meals and things, I would want a full-time nanny at least until my son is old enough to go to school. And even then, with some of my shifts, I need help with transportation to and from school. So for her, we took out a 10-year $700,000. Still 10 years due to our financial independence plans, which don't change regardless of which one of us were to die. And the payout on her is less than mine, not because her function to the family is less valuable than mine. I'd argue it's more valuable than mine. Hers doesn't have a paycheck attached to it. So if I die, income evaporates completely while expenses stay kind of similar. Whereas if she dies, income stays the same because I'll still have a paycheck, but my expenses would skyrocket to replace her function. For her plan, we pay $13. So until the year 2030, we're going to be paying $30 a month to make sure each other is going to be taken care of should one of us unfortunately kick the bucket. And that should cover us until our investments that we're saving up are going to be able to take care of us anyway. So life insurance is completely optional, but I highly recommend it until you are financially independent or work optional. If you are work optional, then you don't need it because you already self-insure what life insurance does. So you'd be wasting your money. And very important is to not ignore stay-at-home parents because they still have significant contributions and expenses will rise significantly in their absence, particularly if there are kids involved. Some people try to sell you on insurance for your children, and that's kind of a scam. Your children add significant sentimental value to the family, but in their absence, your income is unchanged because they're not contributing to the income of the household, and your expenses go down because kids use your income. That's not to say that their loss wouldn't be significant for the family. It just means it's not a significant financial loss, as harsh as that sounds. Whew! That was a lot. I hope this helped dumb down some big topics. Some government employees may have open enrollment in March coming up because many local governments have a fiscal year in July instead of January. So start thinking about your enrollments coming up. Until next time, follow us. Go to our website for some written content. We're currently working on some YouTube content, as some episodes would be better with some visuals. Engage with us on Twitter at Minerva Fire. But most importantly, please share this podcast, subscribe to it, and tell your friends about us so we can all achieve Minerva together.